Eric Muathe, Muathe.com. Now, as we sit here and it is end of October 2017, of course, we've seen the market really stage a very strong move in 2017. So the question becomes, what next? Now, I want you guys to consider taking a look at some historical point of view, and I'm going to recommend a book that probably puts where we are trading into perspective. Now, this is the chart for the Dow going back to 1990. Of course, S&P 500 has also had a nice run and might even have a higher move, and I'll show you why in the coming weeks and months. Take a look also at the Nasdaq, which is also staging a nice momentum uptick, especially since the RSI has remained above 69.1. So the question is, what next? What is the big next direction or the next big swing trade? And of course, we don't know for sure, but we can start looking for clues if after the end of this run, whether the market is going to be staged for a major pullback. Are we somewhere here in the early 2000s or somewhere here in the late 2007 period before the market staged major bear market moves in 2000 here and in 2007? So that's the big question, and we don't want to be chasing a market just because it is moving higher. We need to start being sensitive to the idea that the exact opposite, which is a bear market, might be around the corner. Now, if you consider the Dow from 1900 to present, you can see that we are definitely in a very steep up climb. Now, this is not the first time in history things like this have happened. And keep in mind, this current bull market is pretty much a worldwide phenomenon. So the last thing we want to be doing is be aggressive buyers of the market in periods like here in late 1929. Pretty much you'd want to avoid this major drop that took place here from 1929, excuse me, to about, I believe, 1933, 34. So that was a huge crash. And also we want to avoid periods like here in 2007 going into 2008. We had a huge bear market that took away 13 years of gains. So right now we are trading here, and of course we can see the market has had a very strong push in 2017. So we need to start thinking about the possibility of a major turnaround at some point. Now keep in mind, if you go back to the chart for the Dow, going back about 27 years from 1990 to current market situation, you can see as long as the monthly RSI is holding above 69.1, we can expect the market to continue moving to the upside. Now, generally speaking, and I mean generally, it is very difficult to observe a stock make a major, or a market make a major high while the RSI is above 69.1. Generally what happens, and you can see this for the Dow, coming into 2000, we made an improvement on a monthly closing basis, but it is this negative divergence on the RSI that ultimately led to the bear market move in 2000 to 2002, 2003 here. So this negative divergence is, or was, the visual cue that the market was poised for a pullback. Take a look also here. We can see that the Dow also coming into late 2007, we see the same thing, a slight negative divergence, which also we can see here from a visual perspective was one of the reasons why the market came off the highs of late 2007 before we get the drop here. So right now, pretty much what I'm trying to say is what we can expect here is, so right now, let's say this is the RSI. Now let's say this is the price. And let's take this to be the RSI. And let's take that to be our 69.1 threshold. So as long as we are above the 69.1 threshold, prices should continue moving higher. at some point the theory is that we're going to make a move lower on the RSI, make a lower high, and start pointing down. But in that time frame, the market's going to make a pullback, yes, but the market's going to make a higher high. So it is not out of the realm of possibilities that the market is going to make a higher high while the RSI makes a lower high. That negative divergence is what ultimately will set the stage for what might turn out to be a major top before a major bear market ensues. So what I'm saying is, until we see evidence of a major index making a negative divergence move, we can logically expect the market to have shallow pullbacks until at some point we get negative divergence. Now, I trust all this is making sense. So we go back to the chart for the S&P 500. You can see S&P 500 right now with the RSI above 69.1, which is just where it moves into extreme strength, and we can see evidence of this. So what I'm saying here, in theory, the RSI would have to drop, try to make a new high and fail, pull down. In the meantime, prices will pull back, make a higher high beyond current highs, and then it is that negative divergence that ultimately sets the stage for a major top and then the potential for a major pullback. And remember, that is the theory part of it. In reality, sometimes you'll find that a major top can be reached. For example, take a look at the Nasdaq's major top. It happened with the RSI forming a double top while still above the 69.1 threshold. So it can happen, but that's not usually what happens. Take a look at the top in late 2000 for the Nasdaq. That came with the RSI showing uniform activity rejection at the 69.1 threshold. For example, take a look at the Dow Transports. So if we take a look at what happened in late 99, or let's call it, for the Dow Transports, there was a move to new highs in 1999, but this happened with declining technical strength. So that's what I'm talking about. This period here is not where you get the high. This is not the high. The high comes later here when we have this RSI not making a confirmation of the strength. So again, the top for the transports came in 99 while the RSI was struggling to make a higher high. It is that negative divergence that set the stage for the bear market that began in 2000. So the Dow Transports recorded their high well before the Nasdaq. The Nasdaq would record its high here in March of 2000. So take a look at the Nasdaq. The high for the Nasdaq was in 2000, but the transports were leading the market in a sense because their high came in the middle to early 1999. And again, what I'm trying to explain here is a perfect example. You have to see a retest of the highs with declining strength. That is generally what sets the stage for a pullback. Take a look at the Dow Transports. Again, coming here in early 2000, an improvement to new highs. Take a look at the technical picture. The RSI was making a lower high. That negative divergence is what set the stage for this big move in 2008, 2009, huge bear market. Okay, now take a look at the Dow Transports again. We are making an improvement to new highs in 2017. Take a look at the technicals. What the RSI here is doing is showing negative divergence. So that's why I'm saying we need to start sensitizing ourselves to the possibility that this market is going to top at some point and set the stage for a major bear market. And one other thing also is, if you take a look at the, oh, by the way, before I go into the other aspects here, I recommend that you find a book here, and you can find it on Amazon. I believe it retails for about less than $7. It's a very cheap book to include in your reading, but this is a good it gives you a good understanding of how people can get caught up in a bull market. The book, I believe the first edition was written in 1841, so it's close to 200 years old, but the story of that era and this era, pretty much I believe they are good close examples of why we need to be careful not to be caught up in this strong bull market without considering the possibility of a major turn that might lead to a major generational top or a generational bear market. So it's just something to consider. I'm going to have a link in the description of the video. So again, there should be a link in the description of this video that sends you to Amazon, and I believe it's about a $7, under $7 book. I believe it's worth reading, and I should give credit to where I heard about the book first. And actually the book was first mentioned, the first time I heard about that book was from Kimball Chatting. You can find him on Stock Charts. So he was discussing the book, and I was like, yeah, why not take the chance of reading the book? And I believe it was a great read. It's a great read. I enjoyed the book, and in fact, the fact that it puts a good perspective of how people can get caught up at the top of a bull market is interesting. So I recommend you also do the same thing. And I think I heard about this book when he was being interviewed here by David Modell, and you can find the exact interview on this video here. So that's where he was talking about it. So if you want to take a look at more information, you can go and take a look, search for this video. I should have a link of it in the description. So yeah, so make sure you get your copy of the Extraordinary Popular Delusions. It's a great book, especially when you're in a market that is so strong, it doesn't seem to want to take a pause. You need to have some good historical, I guess, reference point as to why people get caught up in a strong bull market. In other words, we need to sensitize ourselves to the historical levels the market is trading at. And the best thing I would recommend, take a look at this book. Now the book is written in Old English, so it's a hard read, but once you get through, some of the the phraseology and the terminologies, once you get through past that, the message is very, very powerful. So again, there should be a link in the description of this video for where you can get the book. So back to the Dow Transports, just want to show you one other aspect. So we can see there was a break here of a trend line in 2015 for the Dow Transports. That break brought the Dow Transports into what for the Dow Transports was a short-lived correction, maybe even more than 20% drop here, so a bear market. If you take this break and you consider the uniformity principle, you can see that if we draw our resistance line like that, the Dow Transport has been struggling to hold above the previous 2015 break line. So which suggests that this could actually be major highs for the Dow Transports. And if you take a look at the weekly for the Dow Transports, you see also we did make an improvement in terms of weekly closing highs. But take a look at the technicals. That's also negative divergence for the transports. And we can also see uniformity resistance, something I've been talking about over the last couple of weeks. This is the break point. So once we find that top, we get a pullback here, and this is where the RSI broke down. So we draw our uniformity resistance line, and what you see here is a rejection gives us a short-term high, and over the last couple of weeks we formed a double top here. So it looks like the Dow Transports could actually be suggesting that the Dow Transports are running into resistance around the 10,000 level, and potentially they are setting the stage for the Dow Transport to pull back. Now, of course, that starts meaning we need to be more sensitive to the idea that the general market itself might catch the same trend and might ultimately be pulling back. But the reason for this video, to be honest, is I want you to take a look at this book because it really puts things in perspective. Again, Extraordinary Popular Delusions by Charles Mackay, and there should be a link in the description of the video. Eric Muathe with Muathe.com. As always, good luck, peace, and blessings. EACS. Mwah.